Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us at the MarketSite studio, we have Caleb Silver, editor-in-chief at Investopedia, with his outlook for 2023. It is great to see you as always, Caleb, and it's interesting. There's a big list for this year that investors need to be aware of.
Yeah, and we had to slim it down a little bit just because there's so much going on. But let's just hit the top ones and then we'll get into them a little bit. Interest rates, they're going to be higher for longer. And I don't think anybody should expect a big wind down of interest rates here. Consumers are getting a little overstretched by those higher interest rates. We've seen that over the past year. That should continue. Inflation is turning into disinflation. Is it going to turn into stagflation? Keeping an eye on that. And boring is back when it comes to investing. Thank the Lord. Money in the bank now. You can finally earn some money on your savings or in a CD. And the second half of the year hopefully looks a lot better than the first half.
And let's start with the consumer, because really that has been the bright spot, in the economy as we went through the pandemic and, of course, the recovery.
Yeah, the consumers have been spending and they've been resilient. At the same time, we're getting stretched out a little bit, and that is because revolving credit debt is going higher. Credit card debt, $925 billion. That's an all-time high. The average credit card APR now over 22%. As the Fed raises the prime rate, the APRs go up, and they continue to climb. The average debt per borrower, about $9,000. Not everybody has credit card debt, but those that do, that's the average. That's not nothing. And also the personal savings rate, it was so high in 2021 because we weren't spending money. That's down to 2.4%. And revolving consumer credit, as I said, borrowing for everything at an all-time high. So we're right at that stretched out point.
Let's talk more about interest rates. I mean, 22% APR is kind of hard to wrap your head around.
Yeah, it is, especially when you're talking about, maybe not making that full payment every month. You're adding 22% onto what you owe. So for consumers, that can be very, very dangerous. That is what's happening here. But you're getting higher interest rates because the Fed's been raising rates. Fed's going to raise rates at least one more time in 2023 at its next meeting, probably February 1st. And also, you got to look at the terminal rate. When will the Fed stop raising rates? That could be around 5%, could be north of that. We're not quite at 5% yet. So more rate hikes are coming if you look at the dot plot. And then you also have to look at what's going on with the inflation targets. We're getting a slowdown in the growth of inflation, a little disinflation. The Fed wants it at 2%. It's right now right around 5.5% when you look at the PCE. So we still have a ways to go, and that's driving borrowing costs higher.
And market, it's going to be boring, which could be a good thing to your point.
Yeah, the tortoise may beat the hare this year, finally. We've been in a period of growth and growth stocks forever since really the financial crisis. We're finally seeing some value outperforming growth. That's the first time that's happened, about up 15% in just the past 2 months. That could be the trend going into the year. Dividends. Dividends were huge in 2021, 2022. 10.8% increase in dividends by S&P 500 companies. That's a big reward for shareholders that took a loss maybe on the value of those stocks, but they're still getting the dividend payout. And defense beats offense right now, especially if we're going into a recession. You want to be a defensive investor. It doesn't mean avoid the stock market. It means get in those sectors that do well. Staples, healthcare, utilities, stable, slow. The tortoise finally beating the hare this year.
And of course, positioning overall. What are you looking at there?
Absolutely. You got to be on the value train. So you could have ignored it for the past 6 months, but you have underperformed the broader market if you did. So value stocks are where it's at right now. The short-term bonds, they're yielding 4.5%. I think a lot of people would sign up for 4.5% today. Quality stocks at a discount. You're getting a lot of blue chips right now that are very cheap compared to their historic prices. Good time to scoop them up or put them on your watch list. Dollar cost average your way into those. And you got to diversify globally. This is the first time just in the past month, Jill, that emerging markets have been outperforming the U.S. Usually when we get through the economic downturn, they're the first to pop, then small caps, then the rest of the market follows. Keep an eye on that. But more than anything, be patient, Jedi. This is going to be a slog the first half of the year, but then I think it gets a lot better.
All right. Appreciate the insight as always, Caleb. Thanks for joining us on Trade Talks, and thanks for joining me. I'm Jill Malandrino, global markets reporter at Nasdaq.